Okay, let me show you an example of how dividends would be recorded for this particular company, stock to the hand. And it has preferred stock, it's cumulative, dividend rate of 4%. The par value is $50. It has issued 1,000, so that's the amount of cash they receive from issuing their preferred stock. All companies have to have common stock, so it has the 50-cent par value. Again, that 50 cents was set by the company at an arbitrarily low amount. It's not the price that was received when they sold the stock, because you can see here we have excess. So if we look at this particular company, it's issued 500,000 shares. The total amount of cash it received was $3 million. So they got $7 a piece. That's that $3 million they got in cash divided by the 500,000 shares that they had issued to get that $3 million. So the 50 cents, all that is how much goes into the common stock account. That goes here, and then the extra $2,750,000 goes in the paid-in capital in excess of par. Now, on December 10th, the company announces a dividend, and it says it's going to pay a 30-cent per share dividend. Now they will mean the common shares are going to get a 30-cent dividend, because the preferred shareholders get something different, and it's stated right here on the stock. What the preferred stockholders will get when they do in fact declare or pay the dividend, is they'll get par times the rate, sort of like the PRT, par times the rate, and that's $2 per share, and there's 1,000 of those shares. So they're going to have to give $2,000 to the preferred shareholders before the common stockholders can get anything. Now, I'm assuming here that the company has been paying dividends every year. This is cumulative, so if, let's say, this company had not paid dividends last year and now are declaring dividends, before the common shareholders can get this 30 cents, the company would have to pay the $2,000 from last year as well as $2,000 this year to the preferred shareholders. But let's go with this example and assume that there are no dividends in arrears. They're not behind in any dividends. So $2,000 will go to the preferred stockholders. And now for the common stockholders, they're going to get 30 cents per share. Now the key thing is the number of shares that are going to actually get the dividend are only the shares outstanding. Shares outstanding equals the number of shares issued minus the number of shares in Treasury. So the amount the common shareholders will get is 147,000. So the total dividend that the company is committing itself to, because on this date, December the 10th, the company is obligated to pay a total of 149,000. Now, who and when exactly they'll pay it, let me show you that here in a second. Let's first show the entry, because at this point it takes a while to get these dividends paid. So they're going to record the dividend, because they're now reducing their retained earnings in essence, and they're going to record the dividends payable with a credit. Who is this payable to? Well, it's payable to whoever holds the preferred and common stock as of the close of business on December 28th. That's called the record date, or date of record. So if you hold those shares on that date, you'll be entitled to the 30 cents if you own common shares, and $2 if you own preferred. So on the date of record, December 28th comes along. On the date of record, there's actually no entry, but there's a lot of work to be done. The company, if you recall, I showed you the stock quotes in a previous video. There are hundreds of thousands of shares sometimes traded in a day. So it's a tough job trying to figure out who exactly the checks are going to go to. But they figure that out, and when they do finally get it all set, they're going to then get around to paying it. And let's just say they pay it on January 1. They're going to get rid of their payable by debiting dividend payable, and then they're going to credit their cash, and then they've met their obligation. So that's how you declare dividends. Now, I do want to make another comment is that there's also a possibility a company could do what's called a stock dividend, which really it really doesn't do much. I'm not going to get into the entries, except I'm going to let you know that what ends up happening is you're not going to be paying cash. Instead, what you're going to do is reduce retained earnings in essence and give out stock. But the net effect, because reducing retained earnings with that stock dividend and increasing common stock, you're basically putting money in from one equity account into another. You're not growing the company. The shareholders are all getting the same proportion of new shares, so it's basically looking at it this way. It's the same pie, it's just sliced into smaller pieces, and you have more smaller pieces. And that's the same idea behind what's called a stock split. If you look at some companies' stock prices, they can start to get pretty high, and the company really doesn't like that because it makes it harder for investors to properly diversify. So what companies will do when their market price starts to look like it's getting too high, they'll basically do what's called, let's say, a 2-for-1 stock split. So like in this example, if the company did a 2-for-1 stock split, basically what would happen is the par value would become 25 cents. The number of shares issued would become 1,000,000. And of course the authorized would be doubled as well. So the end result, though, is that amount in your common stock doesn't change. It's 250. It's just that this is going to be 25 cents, half, and this will be double. What the idea, though, is, let's say right before you do a stock split, the stock was selling for, say, 70, 80 bucks, let's say $80. Right after a 2-for-1 stock split, the price theoretically should be $40. But what they've actually seen in the research is that you'll see the price be a little bit more than 40, and it makes sense because by making the stock more affordable, it increases the demand, and when you have an increase in demand with the same supply, you have an increase in price. So that's the dividends in a nutshell.